Welcome to the deep dive. Today we're jumping into Centrepoint Alliance. That's ASX, ticker CAF, and their recent FY25 performance. Our mission for you, really, is to unpack how they achieved such strong results, especially when you consider the wider financial advice market is actually shrinking. We want to pull out the key insights for you, and importantly, correct a few things we've seen floating around, particularly about their FY26 guidance and how to read their balance sheet.
Yeah, it really is a fascinating one, and to get a proper handle on it, we'll be looking at it from a few angles. Their financials, obviously, but also how well they actually did what they said they'd do strategically, plus their market position, shareholder value, and what's next. It's about getting the whole story.
Okay, let's kick off with those financials then, because honestly, they look pretty good. FY25, you've got double-digit growth almost everywhere you look. Gross revenue, up 13% to $326.1 million. Net revenue, same deal, up 13% to $40.9 million. But the thing that really jumped out at me, their normalized EBITDA grew 16% to $10.6 million. That actually beat their own guidance. And profit before tax, an even bigger jump, 30%, up to $7.3 million. What's that telling us?
The PBT jump? Yeah, that points to some really strong operational leverage. They're getting more profit out of their revenue growth. And it's not just growth for growth's sake. Look at the efficiency. Their cost-to-income ratio actually improved just slightly from 75 down to 74%. And the EBITDA margin nudged up too from 25.2 to 25.9%. Small moves, maybe, but it shows discipline. It shows the earnings quality is good, driven by the core advice business, fees, the FAM acquisition, less reliance on, older, less predictable income.
Right, so a leaner, more profitable operation. But you mentioned the balance sheet sometimes trips people up. They've got a healthy cash balance, $13.7 million, solid. But the net tangible assets, the NTA, that's lower, $2.5 million. Sometimes a low NTA raises eyebrows, doesn't it? How should we look at that here?
That's a great point, and it gets to the heart of valuing service businesses today. For a company like Centrepoint, most of the value isn't in factories or machines. It's intangible. Think about their advisor relationships, the systems, the brand, and that $26.9 million in goodwill on the books from buying other businesses.
Okay.
So a low NTA isn't necessarily a red flag. It's just the nature of the beast for this kind of company. What really matters is cash flow. And they generated $9.7 million in gross cash from operations. That's strong. It tells you the business is funding itself. It's growing. Yeah. So that NTA figure, you can't really look at it in isolation. It kind of makes you reconsider what an asset even means these days.
Got it. And this strong performance, this growth, it happened while the overall Aussie financial advice market has shrunk. What was it? 19% since FY21? That's huge.
Yeah, massive contraction.
So how on earth did Centrepoint manage to not just hold steady, but actually thrive against that kind of backdrop?
This is where their strategy, and maybe more importantly, their execution, really comes into play.
Right.
While competitors were actually losing advisors, Centrepoint achieved the highest organic net growth in their network. They added 22 ARs, authorized reps.
Wow.
Bring their total up to 571. They're clearly doing something right to attract and keep advisors. And it's not just advisors. Their funds under management, FUM, in the asset management arm, that shot up 40% to $423 million. And their managed portfolios are performing well, beating objectives. Then there's the bigger, longer-term picture with the IconiQ Super platform they launched last December.
Yes, IconiQ. That's a strategic move to capture a slice of the, estimated $73.5 billion in funds under advice across their network. It's about shifting towards that predictable, sticky, high-margin annuity revenue, a really key strategic pillar.
Okay, so defying the market, attracting advisors, growing funds, launching new platforms. What did all this translate to for the shareholders, and what's the outlook now?
Well, for shareholders, it's been pretty rewarding. Since July 2021, the total shareholder return is 125%.
125%, okay.
Yeah, that's a combination of the share price going from about 22 cents up to 39 cents plus consistent dividends. They've paid out 14.5 cents per share in fully franked dividends. That's about $25.5 million returned to shareholders.
Right.
And crucially, let's clear this up. They have given FY26 guidance. Some reports missed this. They're guiding for normalized EBITDA between $11.5 and $12.0 million for FY26. That's another, 8.5 to 13.2% increase on FY25?
Right, so positive guidance is definitely out there. Absolutely. And they're now a tax-paying entity, but expect to keep paying fully franked dividends, helped by a franking credit balance of around $6.5 million. That's valuable for eligible shareholders.
Okay, growth looks set to continue, but with all this activity, new tech platforms, what are the main risks they're juggling?
Good question. Look, the market shrinking is still a reality, but their network growth strategy seems to be the right counter to that. On the tech side, yeah, launching things like IconiQ brings cybersecurity risks. It just does. But they seem proactive. They're doing annual training, they have third-party oversight, and they're aiming for ISO certification by mid-2026. So yes, there are risks, but they appear to be actively managing them, not ignoring them.
Right. So wrapping this up for you, Centrepoint Alliance's FY25 was frankly exceptional. It paints a picture of a really resilient company, well-managed, clear strategy, ambitious, especially impressive given the industry headwinds. We hope this deep dive gave you some valuable perspective on how they're pulling it off.
And maybe just a final thought to leave you with. Centrepoint keeps growing its advisor network, keeps growing assets under management, even while the market shrinks, and its tangible asset base looks low on paper. What does that ability tell us about how we should really be valuing these kinds of service-based, knowledge-based businesses in today's economy? Something to think about.